Millionaires are made in recessions, so the saying goes, and that is almost accurate. If you know what you are doing and analyze the markets correctly, recession is your chance at becoming a millionaire. Most individuals use this period to hold what they currently have and modify their investment strategy for more secure possibilities. There will always be lucrative opportunities to seize in any downturn, regardless of the market or technique you use. Be it in the real estate, cryptocurrencies, stocks, enterprises, etc. In this video, we'll examine the details you need to know about investing during a recession. Keep watching. The stock market is failing, the gross domestic product, or GDP, is declining, and analysts are discussing whether the United States is approaching a recession. Although this is still up for debate, there are many things you can do right away to position your investments for turbulent economic times. The United States has yet to enter a recession formally. While there is still much disagreement on whether or not we're in a recession, the current downturn is quite severe. All markets are down at least 10%. 97% of business owners are cutting costs by more than 10%. And more than 90% of corporations and CEOs are already planning their strategies for a recession. The National Bureau of Economic Research, or NBER, a nonprofit organization in charge of identifying the start and conclusion of U.S. recessions, will only predict once there is enough information. The National Bureau of Economic Research defines a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. Exceptions are made for exceptional occurrences, such as the abrupt fall in the economic activity in February 2020 that sparked the severe, albeit brief, COVID-19 recession. The declines in GDP were caused by supply chain disruptions, says Brian Katz, Chief Investment Officer at the Colony Group. Inventory adjustments and net trade were responsible for most of the negative growth. According to Michelle Griffith, a wealth advisor at Citi Global Wealth, the core NBER definition of a recession also calls for a significant fall in economic activity, which is not yet the case. There is a greater than ever chance that the United States will be in a recession in 2023. According to Rajesh Nakati, Head of Investments, Global Family Office at BNY Mellon Wealth Management, Katz predicts that, even if one does happen soon, it won't resemble the Great Recession or the dot-com bust of the late 1990s. According to him, significant economic imbalances made those two recessions worse. According to malinvestment in the technology sector, the dot-com recession was brought on, and a significant housing bubble sparked the Great Recession. We don't see those same types of imbalances in existence today, Katz says. He thinks that if a recession does occur in 2023, it will affect markets less severely than prior recessions. What to do when a recession strikes? Even if the next recession is anticipated to be mild, you still need to make preparations to prepare your investment portfolio for a downturn in the economy. Number 1. During a recession, cash reigns supreme. According to Citi Global Wealth advisor Michelle Griffith, cash is king during economic downturns. As businesses tighten their belts and job losses mount, it's better to be safe than sorry and beef up cash reserves during times of high employment. It is selling investments to raise money before a recession is risky, though. As markets increase, you can sell too soon and find yourself stuck with cash. A better course of action is to switch to investments that can withstand a downturn. This is why retaining a portion of your portfolio in cash or highly liquid securities, such as a money market mutual fund, is usually a good idea. Number 2. Hold defensive stocks during a downturn. When the economy is expanding, consumer discretionary stocks frequently experience significant gains. Because the gains and losses in this group are based on the ups and downs of economic cycles and consumer confidence, they are known as cyclical stocks. Utility and consumer staple stocks are examples of defensive names in non-cyclical sectors typically sheltered from these ups and downs. Defensive equities can help safeguard your portfolio during a recession. Companies that sell essential services and goods, such as food, electricity, and shelter, are generally non-cyclical and less exposed to economic cycles, Katz says. Food, beverages, and home products are examples of consumer staples whose sales are mostly recession-proof because, whatever the state of the economy, people still need to eat and use toilet paper. Utilities outperform other stock categories during a recession because their demand remains stable. According to NBER analysts, the healthcare sector is stable across the business cycle, in a report from 2021. Employment in the healthcare sector seems to rise in regions that go through more severe economic downturns. Number 3. Purchase cryptocurrency. Due to the risk involved, this market is now the most difficult to enter. But if done properly, it may also bring more opportunities. The strongest cryptocurrencies are currently down more than 60% from last year. $4,865 ETH reached its all-time high at $1,255, and $68,990 BTC reached its all-time high at $16,800, respectively. Focusing on these two currencies will allow you to make a 30% to 60% profit on your investment without waiting for them to return to their previous all-time high. Also, they're currently at a price that makes it an excellent time to invest. We advise against trying other cryptocurrencies in that market because the cryptocurrency industry is currently experiencing a crisis, and you risk losing everything if you try to be overly greedy. However, if you store your primary cryptos in an external wallet and follow all the security tips that financial experts advise, they represent a fantastic opportunity. Number 4. Use dollar cost averaging. With dollar cost averaging, you can buy a predetermined investment amount regularly, regardless of the price. Dollar cost averaging is an excellent strategy for recessions since it allows you to buy shares when the price falls. With new funds, you can get a dollar cost average or the same result by having your dividends automatically reinvested in the security. Number 5. Invest in dependable assets. Investors should seek out quality across asset classes to protect a portfolio during a downturn, says Katz. The characteristics of high-quality investments are low beta, high returns on investments, and minimal leverage. He refers to these businesses as all-weather businesses because their success or survival is not reliant on economic expansion. Businesses with strong recurring revenue, such as subscription-based sales strategies, are less vulnerable to economic downturns. According to him, businesses with a lot of debt should be avoided because if sales and cash flow suffer, they can find it difficult to pay off their debt. If credit conditions and lending standards become stricter, they might also experience difficulties refinancing debt when it comes due. Number 6. Steer clear of growth stocks during a downturn. The time to invest in growth stocks differs from when approaching a potential recession. Growth equities perform poorly during recessions, particularly those of unprofitable businesses with strong growth prospects, according to Nakati. So, in the event of a recession, consider more dividend-paying stocks and income-generating investments instead. Number 7. Purchase dividend-paying stocks. The greatest dividend stocks give your portfolio a cushion during downturns. A business may continue to pay dividends even if its stock price declines. According to Griffith, dividends can signal strength and provide a way to dollar cost average during market volatility. Number 8. Keep actively managed funds in mind. Fund investors might switch to more actively managed funds during a recession. After controlling for risk and expenditures, research suggests that most actively managed funds outperform their counterparts by 4.5% to 6.1% per year in bear markets. Number 9. Bonds and diversified investments. Bonds perform well during recessions, although Katz advises choosing investment-grade bonds to prevent increased default rates. Finally, he adds, truly uncorrelated asset classes may perform relatively well when traditional asset classes exhibit weakness. Examples include royalties, insurance-linked securities, and carbon credits. Number 10. Keep your cool during a recession. Nobody can predict how long or how much a recession will affect the stock market, even if one is imminent. The greatest strategy to invest during a recession is to continue doing what you've been doing. We must determine whether we are or are not in one before the recession is gone. Waiting for a specific time makes little sense because we cannot also forecast the lowest point of a specific market or asset. Right now, the best thing you can do to invest your wealth is to assess your financial opportunities available in all markets and begin making long-term trades. Let's know what you think about the predicted recession and what your plan is to stay comfortable. You can leave your thoughts in the comments section below. Thanks for watching.